They've got it all wrong. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the mainstream media wants you to believe the economy is better than it actually is, and we have some incoming data that shows the economy is continuing to weaken despite the media's claims that it's actually getting better. And we know the media wants you to believe that because they want to maintain access to the Federal Reserve, who needs any information, any suggestion the economy is getting better, because we know they want to continue hiking rates. And I'm going to show you in today's show, of course, the setup of what the media is suggesting is here and what the truth is behind the data. Let's go to the Wall Street Journal, where we pick up the story with the first sign of spinning bad news into good news. Here we have the headline: the world economy is doing well. This is bad news for central banks, but since when is the economy doing well? The global economy is showing vigor, with business surveys this week pointing to widespread revival and growth despite rising borrowing costs and elevated energy and food prices, a sign that central banks may need longer than anticipated to bring inflation under control. So I want you to see here, the media is pandering to the Fed. Of course, we know that if the media does anything to upset the Fed, they're going to lose access to the meetings, the minutes, everything. They get cut off. So of course they're going to pander to this. But what I want you to understand is what we have now is 1 month of data in a series of declines, and suddenly the global economy looks bright. And what this is like, and what I want you to take away from this, it's like being sick and having one day that you actually feel a little bit better, just a little bit, and you get some hope, and then of course the next day, now that was just one hopeful day and you're still sick. In an economic data series, you're going to get some months from time to time that look good, but it doesn't mean the trend changes. But the media, again, they all want you to believe. Data from U.S., China, and Europe have shown surprising vitality in these regions' economies since the start of 2023, confounding predictions from the World Bank and other economists that the global economy was set for one of the weakest years in recent decades. Of course, we're just entering March, and we're not even toward the end of the year when the broad consensus is we are headed to a recession. And if the data further declines from here, it's possible we'll see one start as soon as the second quarter. A key indicator for central banks is the jobs market, which remains tight in many parts of the world. Policymakers have been scrutinizing the labor market for hints of rising unemployment, a drop in hours worked, which has started to happen, or a slowdown in wage rises, which is also happening, all which could help cool demand and ease upward price pressure, but remain elusive. We've seen central banks raise rates, according to Moody's Investor Services, to hope that with a few more rate rises that it will be enough. If it isn't, we could see raising rates even further. So here you can even see the experts want the labor market to get crushed here, because for some reason you raise rates and people lose their jobs. Now, to put this in perspective, I imagine that not one of you has ever gone in an interview looking for a job and been declined because they've said, hey, you know what? We think the Federal Reserve is going to continue to raise rates, and so we can't hire you. And that's the ridiculousness of what we're hearing from these feds and central elites here, is they think that rate rises lead to a lack of hiring or even firing, because I can imagine the same token, anyone listening to the show who's lost their job probably was not told that they lost it because the Fed was raising rates. And in fact, it's the exact opposite that happens as we look at this chart here. When we note the federal funds rate is rising, shown in blue, against the 4-week moving average of initial claims, it's not till the Fed begins cutting rates that we actually start to see an increase in unemployment claims. Either that, or when the Fed starts to plateau and reaches terminal velocity on the federal funds rate, do we start to see initial claims either flatten out or begin to increase. So the notion here that the Fed is driving the unemployment market is completely off. Yet in February, these showed the first signs of rise in global manufacturing output in 7 months, aided by a jump in China after authorities lifted strict COVID restrictions. Similar surveys of service providers around the world to an acceleration of growth, including China and Europe, as inflation rates are proving stickier than expected. So here you see, again, we have 1 month in a series of declines. Of course, citing China, the fact that they're reopening, and of course it makes logical sense that their data would actually get better, but notably it didn't get that much better. And that's the key here. We're on a long run down, and in the economic data world, you will get these one-off months. And the fact that it was a really small increase doesn't bode well for a massive surge in economic activity that policymakers are desperate to have happen. In the U.S., inflation firmed and America's spending and income surged in January. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Price Index, rose 5.4% in January from a year earlier. Now, I want to point out, they're not going to give the next data series on a year-over-year basis. I'm going to give it to you, but I want you to understand why, because they're spinning this for good news. While U.S. consumer spending jumped a seasonally adjusted 1.8% in January from December, the largest increase in nearly 2 years, whereas wages and salaries grew 0.9% in January, more than twice as fast as the prior month. So what they want you to take away from here is, wow, spending surged higher. It surged faster than wage growth for the month. And that must mean people are optimistic. When in fact, if they would have just put the year-over-year data on the wage growth, it would have all made a lot of sense. Here you can see the Personal Consumption Expenditures and Chain Type Price Index. This is from the Fed's data, that 5.4% against average hourly earnings of production and non-supervisory employees. And look at that. They're roughly, you're seeing them decelerate at the same rate. So even though you have a one-off month report that shows spending was ahead of wages, that did not change the deceleration in wage growth, which is critical here. And of course, now that we have the media spin and we know, of course, the Wall Street Journal and all these other publications are going to pander to the Fed, now let's turn and look what the Fed immediately had to say. And with that, back to the Wall Street Journal. Fed official says hotter data will warrant higher prices. I would be very pleased if the data we receive on inflation in the labor market this month shows signs of moderation. This according to Governor Christopher Waller. But wishful thinking is not a substitute for hard evidence in the form of economic data. After seeing promising signs of progress, we cannot risk a revival of inflation. So again, they're all fixated on this 1 month report. From the Fed to the media, everybody's saying, look, all of a sudden things are changing. And of course, in the months to come, we know it's likely to continue decelerating. And now let's get into the real news, the real data that shows this media spin is nothing more than just that. Macys Best Buy sales decline, reflecting shopper pullback. But wait a minute, we just heard the economy is robust. We see both Macys and Best Buy said they expect sales to fall this year after declining in 2022 as stubbornly high levels of inflation and other economic issues weigh on shoppers. The chief executive of Macys said he expects consumers to be, wait a minute, in worse shape in 2023 than they were last year. Now, this report makes a lot of sense. Why are you seeing this? Because against inflation, employees, workers, consumers, they've got less money to spend, and that means retailers, wholesalers are all going to see the impact when the demand goes down. Shoppers are looking to stretch their budgets, buying more lower-cost store brands. Again, makes perfect sense. And smaller sizes of some items, well, of course, we know that's called shrinkflation. They're behaving, get this, as if they are already in a recession. At the same time, consumers are shopping more frequently than they have in recent months. In some cases, still splurging on products they want, such as premium beer. Well, hey, you know what? There's one way to wash down inflation, and maybe that's with a premium beer. I'll let you weigh in on the comments what your thoughts are that. But now let's move into the survey data. So here we're seeing from retailers saying, look, we are seeing people spending at levels. What did he say? Let's go back again. If they're already in a recession, and that is significant. Now let's look at the survey data. Of course, we know the Fed looks at this, and you're going to see a big difference between the S&P Global here and the ISM. This first from the S&P Global, which is of the two reports, one that I consider the data shows is more accurate as selling price inflation accelerates amid renewed upturn in output in February. Here what we can see, activity returns to expansion, albeit only at a slight pace. So there we go. And that just makes the case of what I'm trying to show you here is the media saying, look at the global economy's accelerating. China reopened. The Fed says we got to hike some more. Everything looks rosy. And here you hear from the S&P Global, again, expansion, albeit at a slight pace. New business across the services sector continued to decrease in February. Wait a minute, that's not showing demand of the economy, albeit at a softer rate. So yes, it's still slowed. The impact of higher interest rates and inflationary pressures remain a drag on consumer spending, according to respondents. At the same time, new export orders declined for the 9th month, running midway through the first quarter. Again, you look at that and you don't see a resurgence in the global economy. You start to get the exact opposite. From Chris Williamson, this chief business economist at S&P Global, we're not going to go through this whole piece, but notably, a return to growth of U.S. service sector business activity in February for the first time in 8 months. Again, this is what we're talking about. In first time in 8 months is getting everybody excited, has offset a decline, wait a minute, in manufacturing output, helping stabilize the economy and hopefully avert a shutdown in the first quarter. So what we're seeing now, and again, the data is showing on one side, hey, it went up a little bit. We're all really excited. But the side we don't want to talk about, it went down a little bit. So what was the net growth of the economy? According to the survey data, you got it, nothing. And across both services and manufacturing, job growth has risen into a 5-month high as business confidence about the year ahead has perked up to its highest since last May. The reality is businesses don't want to lay off people in the onset, in the fear that the economy does turn around. If it doesn't, we know the layoffs are coming in a big way. This improving picture, however, has added to the firm's pricing power, having fallen to a 27-month low in January. The rate of inflation for goods and services re-accelerated in February to its highest since last October, as companies reported greater success in passing higher costs on to consumers who maybe have no alternative. They've tried to wait it out, and now they're facing the point where, hey, I've got to buy these things and I've got to pay the price. We should see the knock-on effects in the months to come as demand in other areas fall. But now let's switch over to the ISM, what's considered the more official. And it's not a government report, it's just considered more official. And now we get a completely different picture. You can believe whichever report you like the best. I'll just tell you, in my experience, the S&P Global over time has it right, and the ISM will eventually adjust to it. Here we see the services PMI rocketing higher to 55.1%. Showing that there is definitely expansion back in the services sector. We see business activity, new orders, employment, supplier deliveries, everything looking good. But let's look at what the respondents said in the report. The good ones are on top, but look at this. Seeing a slow decline in activity, but not a collapse like 2009. Well, not yet. Generally flat activity. Continual effort to right-size inventory to match lower sales forecasts. Business activity slightly improved from last month, but notably, customers are now very cost conscious and looking for lower priced product options. So what is that telling you? Is demand is slowing down. This appears to be a one-off month of reports. And let's take a look at the ISM. What could be driving this? Perhaps there is a demand. Look at new orders, 62.6. This is red hot. Prices rising in the services sector, 65.6, also red hot. Maybe the ISM is just suggesting that sales and demand is coming from the fact that they believe that the retailers and wholesalers believe prices are going to keep going higher and they need to buy as much now and lock in those prices. Who knows? We see big differences between the two reports, and I'll let this in this with you deciding which one you think is right. But nevertheless, the media is spinning this as good news, and we can only imagine in the months to come that this one-off small blip in the data is going to continue to show we're headed way down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.